Accounting made easy. Merchandising. This is Roger. Roger is sad because Roger is broke, so he went out to look for a way to make money. Roger loves bread, and he observed that other people also love bread. People always buy bread every day. Roger got an idea. He decided that he also wants to sell bread to get money, so Roger went and gathered all his savings and managed to gather only $20. But he is determined. Roger then went to the bread factory. Bread factory owner says, "I will sell you one loaf of bread for $1. Roger agrees and he invests his $20 to buy 20 loaves of bread from the bread factory. He then went and set up his bread stand business. He sells one loaf of bread for a price of $3 each. Many customers go to his bread stand and buy all his bread. Congrats! Roger is now a retailer. A retailer is someone who buys merchandise from a supplier and sells the merchandise to customers at a markup. Roger is happy. All his bread got sold and he made a profit. But Roger doesn't know how much profit he made. He thought for a while and remembered the first thing he did before selling bread. Roger bought 20 loaves of bread from the bread factory for $20, and he then sold those 20 loaves of bread for $3 each. After doing some calculations, he now knows that he earned a total of $60 after selling all the bread. But that isn't Roger's profit. That is only his sales revenue. Roger then remembered he paid $20 for those 20 loaves of bread, and Roger knows that that $20 should be taken into consideration. So he deducted that $20 he used to buy the bread from his sales revenue of $60. The $20 used to buy the 20 loaves of bread that he sold is the cost of goods sold. After deducting the $20 from his $60 sales revenue, he got a total of $40. That $40 is Roger's profit. Roger is very happy. He is happy because Roger now has $60 and not $20 anymore. He decided to record his sales in his books to keep track of how much profit he made. To record Roger's transactions, we should first look at the beginning before he set up his bread stand business. Roger bought 20 loaves of bread for $20, so a debit to the merchandise inventory for $20 because it is the cost of the bread. It is also to record Roger's purchase of bread as inventory to be sold to customers later. Then a credit to the cash account is made because Roger paid $20 to buy 20 loaves of bread. When Roger sold all his bread to customers, a debit to the cash account for $60 is made because remember, Roger received $60 when he sold all 20 of his loaves of bread at a price of $3 each. To reflect the $60 received, a credit to sales revenues of $60 is also recorded because to get that $60, he had to sell merchandise, in this case, bread. But wait, we are not finished yet. Roger's $60 of sales revenue didn't come from nothing. He sold 20 loaves of bread that cost $1 each to customers, so it should no longer be in his merchandise inventory because he no longer has the 20 loaves of bread. We should record this alongside the previous entry that recorded Roger's receipt of $60 in sales revenue. To do this, a debit to the cost of goods sold account, or the COGS account, is made for $20 because that was the cost of the bread Roger sold to customers. The cost of goods sold account is an expense account. Then a credit is made to the merchandise inventory account for $20 because in exchange for the $60 in sales revenue, Roger gave up $20 worth of bread, so we should reduce his inventory by $20 to show the actual balance left, and that balance is zero. Thank you for watching. That was merchandising made easy by the sketchy accountant. If you enjoyed this video, I would greatly appreciate your support by liking, sharing, and following. Drop a comment too of what accounting topic you want to see made easy to understand.